we have seen why we shouldn't fall for low price stocks thinking they are cheap. And in the same episode, I also touched upon the important concept of PE. In this episode, I'm going to take a deep dive into PE and explain to you some of the practical characteristics of PE and how you should use it. So let's begin. To quickly recap, PE is made up of price in the numerator and earnings in the denominator. Of this, price is completely a market driven factor, whereas earnings is completely a company driven factor. So it wouldn't be unwise to say that price is perception and earnings is performance of the company. So please be mindful of that. Price to earnings ratio won't change overnight, but it will change every day technically, because price will keep fluctuating every trading day. So why PE can contract or expand? PE contraction and expansion can either be price driven or it can be earnings driven. Now I am going to discuss with you some practical scenarios. Let's see how price dominated PE expansion looks like. So when only prices are going up or prices are going up at a faster rate than earnings, then PE expands. And if PE is falling predominantly because of prices, then fall in prices is faster than fall in the earnings. Similar is the case with earnings dominated PE expansion or contraction. Let's look at these scenarios as well. So guys, now let me briefly tell you what has been the PE distribution in the universe of India's top 500 companies. Now let's look at that. As you can clearly see in the table, more than 300 companies have a PE ratio of more than 20, and more than 150 companies have a PE ratio of less than 20. So what can you conclude? Frankly, you cannot conclude anything from this because you don't know what has happened in the past. So here practically you have to look at two more things. What has been the PE series of a particular company in the past, how PE has fluctuated in the past, and what has been the PE of that particular industry. You have to be mindful of these two things. And let me tell you, earnings can also be forecasted. So some shrewd investors, sophisticated investors, institutional investors use forecasted earnings. But at an individual level, frankly, it is very difficult to forecast earnings. So I would insist, stick to trail 12-month earnings, or you can go with quarterly earnings and annualize. I mean, you can use any method that you are comfortable using, so as long it is correct. Okay, so now comes the most interesting part. Many times it happens that you will hear from someone saying low PE stocks are good, low PE stocks should be bought, high PE stocks are bad, high PE stocks should be avoided. This is not entirely wrong, I would say, but you have to take it with a pinch of salt because you cannot generalize it. Now let me tell you why. Now look at what happens if you only invest in low PE stocks. First of all, look at this table and look at the distribution. On your left, you have some of the most expensive companies on PE ratios, and on the extreme right, you have some companies which are trading in single digit PE multiples. You cannot conclude anything from this table, right? Because companies which are available at low PE multiples, most of them are actually, some of them are textile companies, some of them are metal companies, some of them are infrastructure companies, then some of them are what you can say utility companies. So basically you can learn two things from this. Cyclical companies can have extreme PEs depending on the fluctuations in their earnings, or companies which enjoy very high level of profit margins can actually generate high cash flows. So they can naturally command very high PE multiples, because as you must be aware, not very long ago, interest rates in the Western countries were near zero. During those phases, companies which could generate huge amount of free cash flows actually started trading at very high PE multiples. Then which companies will trade at high PE multiples? Companies belonging to sunrise sector, where the growth potential is very high. Those companies can also trade at a very high PE multiple. The reverse is also true. If company is not going to grow at a very fast rate, then perhaps it is not going to trade at a very high PE multiple. Companies where the management record is very good, they can naturally enjoy the valuation premium, so they can trade at a very high PE multiple, and vice versa. So PE actually talks about lots of things. You have to understand why a particular stock is getting higher or lower PE. So that reason is actually important. And if that reason is going to be absent in the future, for example, if a company is growing at 20% CAGR rate for, let's say, for 10 years, suddenly it starts growing at, say, 5%, then it's naturally not going to quote at the same PE multiple, because many people are going to sell that stock, and so on. You have to look at all these things. Now let me tell you some more practical things. Look at this table again. If you have to pick up some companies from, let's say, IT sector, look at the extremes, okay? KPIT Technology is trading at a PE multiple of 63, LTTS is trading at 34, TCS and HCL are trading in the range of 20 to 30, and look at Redington is trading at around 10 PE multiples. So why there is such a stark difference? You have to look at their domain expertise. For instance, companies like KPIT or LTTS, that is L&T Technology Services, those companies are catering to specific niche segments like engineering R&D. You must have heard of autonomous driving and electric vehicles catching up very fast. So KPIT is helping in all segments which are related to the future mobility. So it is belonging to the sunrise segment, and hence it is expected to grow at a very high rate, and which is why it is getting a higher PE multiple. But if you look at companies like HCL Technology or for that matter Infosys or TCS, their businesses are quite stable, their domains are quite diverse, so they are getting moderate PEs. And if you look at Redington is actually, although it is segmented as an IT company, but if you look at it, it's actually distributing IT products. So it is one of the biggest distributors of Apple products in India. Do you know that? It is distributing Samsung products, it is distributing Lenovo products. So you cannot really compare KPIT and Redington. Both of these can be very good businesses, but the way they operate, the growth rates, everything will be different. So which is why I always keep saying that just looking at PE, you can't really tell anything. But if you ignore PE, then perhaps you are going to miss a lot about that particular company. So look at PEs, but don't conclude anything merely by looking at it. But you have to take care of your own money, because nobody else will. Mind your money.